SCHG or SCHD, which one actually builds more wealth long term? One gives you growth, one pays you income. And most investors get stuck choosing between the two paths. Do you chase the growth so your money compounds faster? Or do you take consistent dividends so your cash flow grows even in a down market? SCHG and SCHD are two of the most popular ETFs in the entire market because they represent both sides of that debate. SCHG gives you exposure to America's fastest growing companies with very low fees. SCHD gives you a portfolio of strong cash flowing businesses that reward you with reliable dividends year after year. Both have loyal fans, both have solid long-term performance, but they do very different things for your portfolio. So today we're going to put them head to head. Growth versus dividends. Price appreciation versus passive income. And by the end of this video, you'll know exactly which fund fits your goals or whether a mix of both actually gives you the best of both worlds. Hi, I'm Greg Hardy and welcome back to the channel and thank you for being here. We cover all things personal finance, investing, and building a secure financial future. So if you're serious about taking control of your money and learning something new every week, make sure to subscribe to the channel and like this video. It really does help the channel out and gets this information to more people who need it. Thank you. So let's start out with a quick breakdown. SCHG is the growth ETF. It invests in large cap companies that are expanding fast, especially in areas of tech, healthcare, and other innovation heavy sectors. The whole goal of SCHG is price appreciation. You're buying it because you want to grow your money over time, not because you're looking for steady income right now. It has higher highs, but it also has lower lows, meaning it can move fast in both directions, but that comes with long-term upside. And with an ultra-low expense ratio of just 0.04%, SCHG keeps your costs down so more of your gains stay invested. Now, on the other hand, SCHD is the dividend ETF. It focuses on high-quality companies with a strong cash flow and a reliable history of paying and growing dividends. SCHD is built for stability. It tends to have lower volatility and gives you income even when the market gets choppy. Instead of chasing rapid growth, its goal is to deliver steady returns and consistent payouts. And just like SCHG, it keeps fees low at only 0.06%, which makes it a very efficient income-focused option. So right away, the difference is clear. SCHG wants to grow your money, while SCHD wants to give you money now. Two different goals and two different outcomes. Now, over the past decade, SCHG has delivered very strong growth. As of 2025, the 10-year total return for SCHG is about 420%, which works out to a compound annual growth rate around 18% per year. Now, over the most recent 5-year stretch, SCHG has roughly returned 120%, or about 17.5% per year on average. That kind of performance reflects the benefit of price appreciation and capital gains, especially from SCHG's heavy exposure into tech and healthcare. Think of companies like Apple, Microsoft, and Nvidia. They've driven much of this growth over the last decade. On the flip side, SCHD has taken a different path. Over the past 10 years, it has returned about 206% total, which equates to an annualized return around 12% a year, assuming that dividends are reinvested. Over a 5-year period, SCHD's total return has been around 64%. While this isn't as flashy as SCHG's numbers are, that return includes dividend income, which provides more stability and a smoother performance through varying market conditions. The steady dividend yield and lower volatility make SCHD a more conservative option, especially during market downturns. To make it more concrete, imagine putting $10,000 in each fund 10 years ago. In SCHG, that would have grown to roughly $51,800. In SCHD, it would have grown to around $30,000, but with regular dividend payments along the way, that could have been reinvested or just used as income. This illustrates the classic growth versus income trade-off. SCHG accelerates wealth, SCHD smooths it out and pays you along the way. So what's the realistic takeaway? Over a long enough horizon, SCHG usually wins if your goal is maximal growth and you can tolerate some volatility. But on a risk-adjusted basis, especially if you care about income or sleeping well during downturns, SCHD often wins. And when you factor in dividend and reinvestment, SCHD's total return often ends up much closer than many expect. Most investors focus only on returns, but the part nobody talks enough about is risk, the emotional side of investing. It's not just about how much money your portfolio can make, but whether you can actually stay invested when things get bumpy. And trust me, things always get bumpy. This is where SCHG and SCHD take two totally different paths. One requires a stronger stomach, and the other is built for peace of mind. Now you're going to find that SCHG comes with way more volatility. You get bigger swings both up and down because the fund is packed with fast-moving companies that live and die by future potential. For example, during the COVID crash of early 2020, SCHG dropped around 30% in just a few weeks, but then rebounded faster than the broader market did. That's why SCHG works best for people with long time horizons, who don't need income right now and who won't panic sell when the market dips. Now, SCHD is almost always the opposite. It's built for stability, steady dividends, and smoother performance, because SCHD invests in established companies with strong cash flow and consistent dividend histories. It doesn't move as violently. During the same 2020 crash, SCHD dropped closer to 20% and bounced back steadily, with dividends providing a bit more of a cushion. For many investors, especially beginners, that stability makes SCHD easier to hold emotionally, even when the market feels chaotic. This is exactly why some people swear by growth funds while others swear by dividend funds. It's not just about math, it's about mindset. If volatility gives you anxiety, you're naturally going to lean towards SCHD. If you're okay with riding the roller coaster for bigger long-term gains, SCHG might be more your style. But at the end of the day, the best investment isn't always the one with the highest return, it's the one that you can actually stick with. So when you look under the hood, SCHG is built around market leaders in tech and innovation. Like I mentioned before, those are companies like Apple, Microsoft, Nvidia, and Amazon. They dominate the fund. They reinvest heavily into growth, which explains the ETF's upside during expansion periods. And I can't emphasize this enough, but the very low expense ratio of just 0.04% means more of your gains stay invested, helping long-term compounding. Now, SCHD goes in a completely different direction. It leans into financials, industrials, consumer staples, and other strong dividend-paying sectors. Think about companies like 𝐬𝐮𝐬𝐫𝐞𝐭, Coca-Cola, Pepsi, and Home Depot. They provide stable cash flow and strong dividends. SCHD screens for quality, durability, and a proven 10-year dividend growth record, making it one of the strongest dividend ETFs on the market, and it also has a very low expense ratio. So you're really not choosing between a good and a bad investment here. Both funds are cheap, well run, and backed by strong histories. The fun part is they simply serve two different purposes. SCHG gives you growth, and SCHD gives you dependable income and stability. SCHG is best for investors who are playing the long game. If your goal is to grow your wealth over decades and you don't need income from your portfolio right now, SCHG fits that mindset perfectly. It's built for people investing for retirement with a 10-plus year horizon and who can handle emotional swings. SCHD is ideal for investors who value stability and reliability. If you like earning dividends or want a portfolio that feels steady even when the market gets messy, SCHD checks those boxes. It's especially appealing for people closer to retirement or planning ahead for future income. Neither mindset is right or wrong. It's about your season of life, your goals, and your personality as an investor. Some people love high-growth roller coasters. Others prefer consistent payouts and smoother performance. Both are a valid path to wealth. A lot of investors think these two ETFs compete, but they actually complement each other. Growth gives long-term fuel, dividends give stability, and together they can create a portfolio that grows, pays, and lasts. Here's how I look at it after years of investing. SCHG is the growth engine, and SCHD is the income engine. SCHG gives exposure to innovation in companies shaping the next 10 to 20 years. If you give it enough time, it can accelerate your portfolio. SCHD, on the other hand, is about consistency. It delivers reliable returns and dependable dividends, providing peace of mind. Now, if I were chasing faster long-term growth, I'd put more weight into SCHG. If I wanted steady cash flow or a smoother ride overall, I'd lean toward SCHD. And honestly, you don't have to be a team growth or team dividends player. Blending them gives a portfolio that grows and pays. SCHG gives you upside potential, SCHD gives stability, and together they fill in each other's gaps. This fits right into the simple three-fund structure that I've talked about before. SPYM is my core. Gives me broad market exposure, low cost, steady long-term growth. SCHG is my focused growth piece, capturing innovation. SMH is my conviction play, more concentrated but high impact when semiconductors run. Adding SCHD provides dependable income without complicating the system. It keeps the portfolio simple, diversified, and built for decades of growth and durability. At the end of the day, choosing between SCHG and SCHD isn't about chasing the best fund. It's about picking the strategy that matches the life you're building. Money grows fastest when your investing plan aligns with your temperament. Some people are energized by riding long-term innovation. Others are motivated by seeing real cash hit their account every quarter. Both paths work. The real mistake is forcing yourself into a style that doesn't match who you are. The more comfortable you feel, the longer you'll stay invested, and that's where real wealth comes from. Sometimes the smartest move isn't picking a side at all. It's designing a portfolio that lets both approaches work together. Growth gives acceleration, dividends give durability. When combined intentionally, you create a portfolio that builds your future while supporting your present. Most people overcomplicate investing, but SCHG and SCHD prove that you don't need 20 different funds to create long-term wealth. You just need a strategy you believe in, the discipline to stay consistent, and the patience to let time do what it does best. Now, if you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video here. And also, please make sure to subscribe. Thank you for watching, and I'll see you in the next one.